Welcome back to The Street. Yesterday, our Amber Kanwer spoke with Armen Panossian. He's head of performing credit at Oaktree about the recent growth in private credit.
You know, it's really because the banks have stepped away from the markets in a variety of different ways. First of all, the investment banks that historically were very active in using their balance sheets to commit to deals and then syndicate them, they suffered really big losses in that syndication process in 2022. And then separately, following the Silicon Valley Bank fall, there has been more regulation and oversight on what regional banks or commercial banks do with their balance sheets, and some concerns around especially their real estate portfolios and other risky loans that they took on over the last few years. So from a regulatory perspective, there's a retrenchment, and then from a dollars of loss perspective, there's a different set of requirements or needs for a retrenchment.
But is the retrenchment also part and parcel because of an economic forecast that, you know, is kind of like waiting for Godot, the recession, but at some point that a recession shows up, and so these banks are pulling back? Should we be worried about private players stepping in at a time where maybe banks are pulling back because they're worried about lending money in a cloudy economic environment?
You know, I think they're worried about their legacy portfolios. Banks do have a significant portfolio of interest rate sensitive asset classes, like real estate, like leverage buyouts, which are also a real estate sensitive asset class. So as they look at their portfolios, they are concerned about the performance in them and the default and loss risk. Now, looking forward, however, that risk in the rearview mirror creates an opportunity out of the front window. And that is if you are a private lender and you are focused on capital solutions that are highly structured and well priced, then you could actually avoid troubled situations and take advantage of the dislocation.
So are opportunities showing up at your doorstep that, you know, traditionally would go to a bank? Or is it that, you know, deals or whatever that could be financed by a bank, well, that door is now shut, and so they're coming increasingly to you?
Historically, the deals would go to the banks, or the banks would be a material competitor to the private credit market. But because they've stepped back, the private credit investment managers have gained market share in what was historically really classic bank lending. You know, one example in the investment banking context is just LBO finance. The leverage buyouts. So the leverage buyouts historically were funded by the investment banks and then syndicated out to various different types of managers. But the losses that they have suffered have caused them to step away. And then separately in the regional banking context, a lot of loans are made on medium to small sized real estate assets. The banks are suffering from stress in those portfolios, and so they are the incumbent lender, they're stepping away, and as a result, they're also stepping away from other adjacent asset classes, like equipment finance, trade receivables, other small and medium-sized lending that they traditionally have done with borrowers, and now the institutional asset class or institutional fund managers need to step in where they stepped away.
So, but you also have to have a macro view. So you're making these investments. What is the macro view? Are you stress testing for a recession?
We're not calling a recession necessarily, but we're absolutely stress testing for a recession. We're also stress testing for higher rates for a very long period of time. I don't think we're going to be seeing...
What's high, like 5% or even higher?
In terms of base rates,
yeah.
At least 4% in terms of base rates. Today, base rates are 5.25-ish. So we could see potentially some reduction in rates if there is a moderate recession, but I don't think we will see any reduction in rates if they're sort of steady as she goes in terms of the way the economy is currently operating. The economy is actually quite strong right now.
And is that why when you look at areas like high yield or typically, you know, even more distressed categories, you're not maybe finding as distressed as it was perhaps you know, a couple of years ago?
I think the distress is going to come.
Okay, where?
I think it depends on, it's going to be certain industries, interest rate sensitive industries, you know, for example, relating to building products companies rely on easy access to capital for the consumers or homeowners that borrow to then build their house or to improve their house. That's just one example. Other industries that require easy access to capital markets, so for example, some high-flying technology companies that need a functioning equity or debt capital market to continue to finance their cash burn, I think those are in trouble. So the stress and the distress is coming. However, the reason you're not seeing it yet is, one, economically, there's been a lot of stimulus. In the US, there's been the CHIPS Act, the Inflation Reduction Act, and so that is inflationary, that is positive for the economy. But the other reason is that specifically in high yield bonds, for example, it's actually the highest quality it's been in at least 10 years. And so the leverage is lower, it's manageable, and most high yield issuers actually did a good job of kicking out maturities, so they actually have the benefit of time and a fixed cost of borrowing. Where you are seeing the stress right now are on floating rate borrowers, and it's happening real time because their cost of borrowing is resetting every quarter.
Yes, that's right. Last question, kind of related to that, there's a lot of concerns, commercial real estate. Are you sniffing around there? Too early for you?
We are sniffing around, but it is too early. I think the worst is yet to come in commercial real estate. Right now, you are seeing commercial real estate, especially in office, that has had a maturity or has a significant decision to be made with respect to additional investment in a property. Those are going back to the lenders already. What you're not seeing yet are higher quality assets like industrial or multifamily going back to lenders, but I think you will. Now the reason is this, those two asset classes were always the darlings of the real estate. They were the highest quality, and therefore they usually had the most leverage because they had the most consistent, dependable cash flows. So their leverage profile tends to be higher, which means that at some point when those rates reset, they will have rate-related stress rather than fundamental asset level stress, which we're seeing in office properties for the time being.